We have already been tipped into a global recession, and the banking system is on the verge of a total collapse. That is the latest warning from Rick Rule, one of the most respected investors alive, in his latest interview. If you do not know who Rule is, you need to. He has been investing in natural resources and precious metals for over 40 years. He is the founder of Rule Investment Media and the former president and CEO of Sprott US Holdings. He personally runs a bank. He has made and managed fortune through every major crisis since the 1970s, and he went into 2008 so well capitalized that 2009 became the single best investment year of his entire career. In this interview, he warns that a global recession has already started, that banks are carrying massive unrealized losses on their balance sheets, that trillions in high-yield bond ETFs could trigger a run on the bank with no FDIC backstop, and that the penalty for not having liquidity when the crisis hits is catastrophic. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you are getting value from the videos, hit that subscribe button. It is free, it supports the channel, and you can always change your mind later. Now here is exactly what he said.
But I would suggest to you that if we weren't already in a recession, that this conflict has tipped us into a global recession. That will have the odd benefit of reducing demand a little bit, but it won't do good things for the rest of your life. I also believe, as you and I have discussed before, that the stated rate of inflation is very different than the real rate of inflation. If normal people looked at the basket of goods and services that they consumed, and they compared that with the price increases in the consumer price index, they would see just how silly the reported rates of inflation are. I think it's important. I have seen markets before where there's a crisis of confidence, where there's a liquidity squeeze. I'm not saying this is going to occur. I'm not even going to say it's a probability, but it's a strong enough possibility, and the penalty for failure is high enough that I'm building liquidity. The last time I saw concern about credit become a contagion was 2008, and I watched in a fairly short period of time equities markets lose half of their price support. The consequence of going into 2008 well capitalized and also well educated was that 2009 was the single best investment year of my career, percentage-wise. But what's important to note is that increasingly the Fed is losing control of the interest rate. They lost control of the long-term rate a year and a half ago, when, although they were driving down the short-term rate, the long-term rate decoupled from the short-term rate. Now you've had two straight weak Treasury auctions, and you have weak Treasury auctions in the face of something like $10 trillion needing to be refunded in the next 12 months. The Fed has one choice, really, which is to print. If they allow interest rates to rise, they, at least in the near term, damage the economy, and not coincidentally damage the government's ability to pay interest on the $40 trillion that they already owe bondholders. If you did quantitative easing, it would be called counterfeiting, and you would be put in the penitentiary. If you're an elected representative, of course, it's called fiscal management, and you get reelected. And when I look at the big banks, and I see a bank with, let's call it $500 million in equity, and that is sitting behind a $60 trillion derivatives liability, I wonder how well capitalized they are. Banks are allowed to list debt securities on their balance sheet as held to maturity. So a bank that owns a 15-year bond that's selling in the market at 65 or 70 is allowed to carry that bond on their balance sheet as 100 because they, quote, intend to hold it to maturity, which is to say that the mark-to-market losses in bond portfolios in a rising interest rate environment has not been accounted for on bank balance sheets. I also point to the fact that there are as yet unrealized losses to private credit, and in particular to commercial real estate. I would argue with you that extend and pretend is coming to an end. So to suggest that the banking industry is as solvent as we would like to believe it is not true. You asked me if the banking industry was more solvent. The answer to that is yes. Is it solvent enough? No.
So there is Rick Rule, a man who personally runs a bank, telling you that the banking system is not solvent enough, that bonds on bank balance sheets are being carried at 100 when they trade at 65 in the open market. That $60 trillion in derivatives liability sits behind $500 million in equity. That extend and pretend in commercial real estate is ending, and that the Fed has lost control of interest rates with $10 trillion in debt needing to be rolled over in the next 12 months. The data is confirming every piece of this. In January 2026, the CMBS office loan delinquency rate hit 12.34%, the worst ever recorded and worse than the 2008 financial crisis. $930 billion in commercial real estate debt is maturing this year. A 50-story tower in Manhattan defaulted in January because the balloon payment could not be made. In Denver, office vacancy is above 36%. On private credit, the freeze is already happening. Apollo and Ares have both capped investor withdrawals at 5% after facing redemption requests above 11%. JP Morgan has started questioning loan values and pulling credit lines. The private credit market has ballooned to over $3 trillion, most of it sitting on opaque balance sheets with no mark-to-market discipline. The equity markets are starting to crack. The S&P 500 is down 4% on the year. All three major indices have broken below their 200-day moving averages. Moody's Analytics puts the probability of a US recession at nearly 49%. Goldman Sachs has it at 30%. The economy grew at just 0.7% in Q4 2025. February payrolls contracted by 92,000 jobs. And on the national debt, Professor Steve Hanke and former Comptroller General Dave Walker published research in Fortune showing $6 trillion in government assets against $136 trillion in total liabilities when Social Security and Medicare are included. The country is technically insolvent, and the Treasury just had 2 straight week auctions while $10 trillion needs to be refunded this year. Now, Rule explains why the one thing nobody is watching could be the thing that blows the whole system apart.
There's a huge proliferation of products in the United States and Canada. High-yield ETFs, exchange-traded funds that invest in, for want of a better phrase, junk bonds. And they're owned by people who I inelegantly term yield whores. Ma and pa investors who are chasing 150 or 200 extra basis points in yield with no knowledge of the credit risks that they're running. These ETFs are extremely liquid. There's trillions of dollars in AUM, and they trade billions of dollars a day. The difficulty is that the underlying assets that they own, over-the-counter bonds, high-yield bonds, are extremely illiquid. And if you have disintermediation, if the mas and pas that own these ETFs go to redeem them, the managers who run the ETFs may be unable to sell the bonds that would fund the redemptions. There you would get a run on the bank with no FDIC. In that regard, it reminds me of nothing so much as the air in the CDO market before the 2008 real estate credit collapse. The increase in oil prices that you've seen is anticipatory. It isn't reflecting shortages, it's reflecting the imminent prospect of shortages. We have lived on strategic reserves and floating inventory until now. If the blockade goes on, then you're going to see real oil price increases. Those will truly be ugly. So the $102 that you see on Bloomberg reflects 140 to 145 pre-shipping landed. When people look at the Straits of Hormuz and they hear the headline, 20% of the world's supply of crude moves through the headline, what they don't read is something much more stark, which is to say that in excess of 50% of the world's export crude flows through the Straits of Hormuz. 35% of the world's LNG, the substitute, flows through the Straits of Hormuz. Mark my words, if this goes on, it doesn't get worse. It gets much, much, much worse. If you take a shock to the economy, like the increased amount of GDP that's going to energy, before the economy can resolve itself to it, it acts like a tax. There's less cash available for other uses. The second order effect is that it affects confidence. People are less willing to spend, they're less willing to invest, they're uncertain, so they do nothing. The consequence of what is in effect a tax, depriving the economy of resources and depriving the economy of confidence too, cannot in the near term have a happy outcome.
So there is rule connecting the two biggest threats nobody is talking about in the same sentence. A high-yield bond ETF market with trillions in liquid wrappers around illiquid assets, and an oil shock that is acting as a direct tax on an economy that was already weakening. Put those two together and you have a consumer who cannot spend, a corporate sector whose margins are getting squeezed, and a credit market sitting on a structure that could lock up the moment confidence breaks. On the oil shock, the data since this interview has only gotten worse. The dated Brent price, the benchmark for actual physical oil deliveries, hit $144, the highest ever recorded since S&P Global began tracking it in 1987. Gas has crossed $4.16 nationally. In California, it is approaching $6. In Los Angeles, $7 a gallon. Diesel is forecast to peak above $5.80 this month. The EIA reports Middle Eastern producers have shut in up to 9 million barrels per day. The IEA has warned this crisis could be worse than the oil shocks of the 1970s. On the consumer, 86% of Americans now say gas prices are their top financial concern. Moody's confirmed the top 10% of earners drive nearly half of all spending. Deloitte says the bottom half of the economy is effectively already in recession, and on housing, Redfin reported 630,000 more sellers than buyers last month, the largest gap on record. Homes are 30% overvalued. The Shiller-Cape ratio on the S&P 500 sits near 40, the second highest ever recorded. The Buffett indicator is at 213%, the highest on record. Both flagged the dot-com bust and 2008 before they happened. Both are flashing red right now. And here is the key difference between Rule and most other analysts. He is not making a prediction. He is making a preparation. He sees a greater than 20% chance of a 50% decline, and he believes the penalty for being caught without liquidity is so severe that he would rather lose 4% a year in real terms on his cash than be caught in the wrong position when the crisis hits. Here is how he frames it.
I'm getting paid something like 4% on my liquidity in a currency where I believe I'm losing 8% of my purchasing power, which is to say, arithmetically, I'm not making 4%, I'm losing 4%. I regard the 4% that I'm losing in real yield as being an option payment, an option premium to preserve my liquidity in case that liquidity comes in handy. Buffett will tell you during the time he's operated Berkshire Hathaway that the share price has fallen 50% or more over 18 months, 4 times. Anybody who is in the equities markets who isn't prepared for a 50% decline shouldn't be in equity markets. I've been in equity markets for a very long time. I think there's a less than 50% chance of it occurring, but I think there's a more than 20% chance of it occurring. And if it occurs, I'm afraid it gets underway in earnest. The difference between taking advantage of a liquidity squeeze and being taken advantage of in a liquidity squeeze is simply liquidity. Uranium is actually the greatest beneficiary, I think, over time of the Gulf conflict. Uranium offered the only commodity that was energy dense enough that a nation could store all of the fuel that they needed in one warehouse to sustain the country's economy for 5 years. We're relearning that lesson right now. No country more thoroughly than Japan. There's a 41 reactor fleet. They've restarted 16 plants. The Japanese now have the impetus to start their remaining nuclear fleet. And that takes uranium now. The energy security afforded by uranium at the same time that the world is desperately short of baseload power and would prefer non-carbon generating power means that the clearest of all beneficiaries of the Gulf conflict is uranium.
So there is Rick Rule laying out the full picture, and the reason his warning carries so much weight is because of what he is doing with his own money. He is not buying, he is building cash. He is accepting a 4% annual real loss as an insurance premium because the penalty for being caught without liquidity in a crisis is catastrophic. This is a man who has been through every major crisis since the 1970s. He went into 2008 prepared and had the best year of his career in 2009. And right now, he is preparing for the possibility of a repeat. The banking system is carrying unrealized losses on bonds marked at 100 that trade at 65. $60 trillion in derivatives exposure sits behind $500 million in equity. Commercial real estate extend and pretend is ending. High-yield bond ETFs have trillions in liquid wrappers around illiquid assets that Rule himself compares to the CDO market before 2008. Private credit funds are already gating withdrawals. The Fed has lost control of the long end of the yield curve. And $10 trillion in government debt needs to be rolled over in the next 12 months. Gold above $4,650, silver above $75, oil at record physical delivery prices, the S&P 500 at the second highest valuation in history, commercial real estate defaults at all-time highs, recession odds approaching a coin flip, a consumer already breaking under $4 gas, and one of the most experienced investors alive choosing to sit in cash and wait. The question is no longer whether the stress is real. The question is whether you have the liquidity to survive what comes next, or whether you will be one of the people who gets taken advantage of by those who do. Stay informed, stay prepared, and make sure you are subscribed because we are tracking every development as this unfolds.